Hello, this is Japanese Economic Review Channel. Thank you for joining us today. We will analyze the March 2026 condominium market trends in the Kinki region. Our focus today is record values hidden behind dropping averages. We will uncover the true market realities masked by superficial figures. Let's look at the overall snapshot. Supply surged by 24.3% year-on-year to 1,975 units, breaking previous lulls. The contract rate remains robust at 74.9%, clearing the 70% health benchmark. However, inventory has slightly ticked up to 3,308 units. Here lies the paradox. The average price plummeted by 13.5% to 47.59 million Japanese yen. However, the price per square meter actually grew by 3.9% to 98,500 Japanese yen, marking the highest March value since tracking began in 1973. Why did average prices drop while unit values set new records? The answer is the massive influx of investment properties. Out of 1,975 units, 48.1% or 949 units across 12 projects were narrow area investment units. This heavy concentration of lower-priced, compact properties artificially skewed the overall average price heavily downward. By isolating the general residential market, a different reality emerges. Stripping out investment units, the true average price jumps to 67.94 million Japanese yen, over 20 million higher than reported. Meanwhile, the contract rate cools to 67.8%, indicating affordability challenges for general buyers. Looking at unit layouts, the product mix is strictly bimodal. We see massive spikes in 1K and 1 LDK units for investors, alongside strong supply in 3 LDK units for established families. The missing middle, such as 1DK and 2 LDK, perfectly reflects this bifurcated demand. This bimodal trend mirrors price stratification. The market operated in two distinct arenas: high-volume, low-price investment units under 25 million Japanese yen, and premium family units clustered between 50 and 70 million Japanese yen. There is almost no overlap between these two buyer segments. Geographically, the supply surge was highly localized. Osaka City was the undeniable engine, accounting for 40.7% of total supply with 804 units. Combined with the rest of Osaka Prefecture, this area generated nearly 67% of the entire Kinki region's market volume. Regional performance varied significantly. Osaka City's blistering 85.0% contract rate defies the broader market cooling and single-handedly pulled the region's blended rate up. In contrast, Kobe and Kyoto cities saw much lower rates at 69.4% and 66.2% respectively. Despite the severe product mix anomaly, foundational buyer demand remained relatively steady. The contract rate has safely cleared the 70% viability threshold for 4 consecutive months, reaching 74.9% in March, demonstrating sustained overall market vitality. Taking a macro view, while monthly supply remains volatile, the fundamental value of real estate is hardening. The price per square meter has risen for 6 consecutive months. This sustained premium growth proves that the underlying asset values are not deteriorating. In conclusion, the Kinki market remains fundamentally highly valued. The 13.5% drop in average price was a statistical mirage caused by a spike in investment units. With April's supply forecast returning to a baseline of 1,300 units, buyers face persistently high barriers to entry. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.